Hello, my name is Jerry Yu, and welcome to my YouTube channel. See, our topic today is how to maximize your income using an index annuity. What we will talk about today is kind of a broadly of what an annuity is, and we will get into some of the mechanic of an annuity. We'll look at somewhat of a product specific and talk about two of the separate accounts within an annuity policy, and kind of inner working of an annuity. Before we get started, I wanted to give you a quick analogy. See, if you're considering purchasing an annuity, and chances are you are getting closer to retirement. So what we do is compare your working career in retirement to climbing Mount Everest, the tallest peak in the world. See, when you are climbing Mount Everest, you are preparing, you are doing everything you can to reach the summit. But that's not where your climb ends. See, your climb ends when you safely reach the bottom and you made it home safely. Retirement is just like that. Your working years, you will strive to get into the peak, the pinnacle of your working life. And eventually you stop at the top and you enjoy retirement, but then you must get down through the rest of your life with the amount of income that you need. See, if you can't get down that mountain safely or through retirement with the right amount of income that you needed, you may not make it, and you could run out of money. See, we're going to show you how to maximize your different sources of your income using annuity. So what is an annuity? An annuity can be a promise from life insurance company to you or your spouse that you will never run out of money, that your essential expenses are covered. See, your mortgages, your healthcare costs, whatever those things are that you cannot outlive. See, you want to make sure that is protected and that you have enough income to get through retirement. One way we do that is we transfer the risk out of the stock market, out of some sort of an investment portfolio, and we take that away the risk, and then we get the money over to the insurance company for a promise of income and peace of mind. Next, we're going to talk about mechanic of annuity. Let's talk about the relationship between you and the insurance company. See, when we're using annuity as a string of income for retirement, we need that money to last 25, 30, or 35 years, as long as you are alive. See, you will have a string of income, and what the insurance company is going to do is incentivize you to transfer some asset over, set that income floor, and then keep it there for the rest of your life. Even your account balance goes to zero, but you will never run out of the income. And that is the most value from an annuity policy. And typically, annuity is funded with a lump sum from a stock portfolio or 401k or IRA rollover. See, we move that money over in a lump sum. See, the money you already accumulated, but we transfer the risk to the insurance company. And then we give you that income. See, there are two phases in an annuity. We have our deferral or accumulation phase, and then we have our distribution or income phase. See, you move that money over 5, 6 years before retirement, and you let it defer. And eventually, you start your distribution. You take income from this annuity, it's deferral. You let it park, you earn interest, and have a lot of gains and bonuses. And when you're ready to retire or whenever you want that income stream, you tell the insurance company, and then they go ahead and provide that for the rest of your life. Okay. And let's talk about the accumulation value and versus the income account value. See, your accumulation value and your income account value are two simultaneous accounts within one annuity. Typically, it is a plan specific, and I recommend you to work with your insurance professional, or you can contact me on the ins and outs of each annuity that you are looking at. For today, we're going to talk about an index annuity with two accounts. See, your accumulation value is your walkaway value. If I surrender this contract, I don't want it anymore, and go ahead give me all my money back, and minus any withdrawal or any surrender charges, and that is your accumulation value. It's typically credited annually. So you have a starting point and the ending point at the beginning of the end of the year, and the difference between the growth within the contract provide a percentage of interest, and that's what you will be credited. See, we usually average about 3 to 5% on the index crediting, and it can be used as a death benefit. Whatever leftover that you have not used for your income can be provided as death benefit for your beneficiary. We'll see it's somewhat irrelevant because your accumulation value typically goes to zero. And even your account balance go to zero, insurance company is obligated to pay you your income stream for the rest of your life. So you will never run out of money. See, if your account balance go to zero, and that's a good thing, because then you are living off the insurance companies, and that stream of income goes for the rest of your life. And that's to talk about the income account value. Okay. And this is the fun part. We want to get this income account as large as possible. The bigger your account value, the more income you will get. With the income value, when you decided to tell the insurance company that you wanted to start your income, there's going to be an associated withdrawal rate. For example, you transfer $750,000 to the insurance company, and 5 years later, your income account balance is somewhere near about $1 million. For example, based on the payout percentage at a certain age, they might start giving you 4.5% of that as a starting point for your annual income for your retirement. See, working with your insurance professional or contact me to work on your specific situation. Every family is different. See, many companies will give you an upfront bonus. So you will see an 18% premium bonus as an example. That means that you move over $1 million and instantly you will get a $180,000 bonus to that income account. See, while you're deferring during that deferral stage, they will offer an interest rate bonus, the 250% multiplier. Let's say that you get 5% return from your index account, and they will credit that 2.5 times, or you would earn 12.5% on your income account value. And you want that to grow as large as possible. And that's how you get the most amount of your income. See, you wanted to find a product or an insurance company that's going to give you those different bells and whistles to help it grow. Whatever's left over can also be used as a death benefit account, and your income account's typically going to be quite a bit bigger than your accumulation value. See, your beneficiary has to make a choice. Do I take the lump sum, or do I want the income account value? The only caveat is that typically they have to spread out over an amount of time, in this case about 5 years, to take in the accumulation value. See, one very important thing is that you wanted to have an annuity or a product that has an increasing income, because inflation is a real thing. And we wanted to see the growth in your account to cope with the inflation. Otherwise, a level income will lose purchasing power every year that we realize inflation. See, work with your insurance professional or contact me to discuss this ins and out of annuity. But just know that it provides you a peace of mind. It's that protection that even you run out of money, you will never run out of income. And that's how we want to maximize your income using an index annuity. Thank you for watching.